Welcome back to the deep dive. Okay, so our mission today, October 15th, 2025, is really to cut through this just massive amount of crypto news. Finance, regulation, it's all happening.
It really is.
We've pulled together a bunch of sources, and they kind of tell this story of, well, tension, I guess. You've got huge institutional money pouring in, right? Bitcoin's over $112,000.
Yeah.
Ethereum past $4,100.
Yeah, big number.
But then you look at the general investor vibe, and it's nervous. Definitely nervous. So we're not just going to read headlines. We want to dive deep into what's causing this contrast. Specifically, the explosion in institutional cash, how governments globally are trying to finalize the rules, and what this all means really for digital assets becoming, well, part of the foundation of finance.
And the context here is, I think, critical for anyone listening who wants that, comprehensive, actionable insight. The market's undergoing this historic shift. Yes, prices are hitting milestones, no doubt. But the really crucial stuff, it's happening behind the scenes. Regulatory offices, corporate boardrooms, that's where the action is. We need to figure out the so what behind these huge capital moves and understand why, despite these crazy high valuations, there's still this fundamental caution dominating how people feel about the market.
Okay, let's unpack this. Let's start with the basics, the metrics, which are frankly massive. So the global crypto market cap today, $3.82 trillion. That's up, what, 1.21% in just the last 24 hours?
Significant growth.
Yeah, and altcoins, they're holding strong. Like 38% of that whole pie is alts. Looking at the big names, Bitcoin, kind of steady, actually. $112,037, up maybe 0.5%.
But if you look at the other majors, Ethereum is really the standout today. It's up 3.29% to $4,106.87.
Wow.
And you also see Solana, $203.04, XRP, $2.49, BNB, $1,185.75. I mean, they're all showing pretty strong gains, multiple percentage points up. On paper, you'd think party time, right?
Exactly. Which makes this next bit, kind of weird. You mentioned the anxiety underneath it all. Let's talk about that fear and greed index. Because despite these great-looking numbers, the index is sitting at 37%.
Yeah, 37. And that puts the market squarely in fear territory.
Right. Here.
And this is the core puzzle, isn't it? Why is everyone seemingly so fearful when all this institutional money is clearly pushing prices up to these record highs? It kind of suggests that, the average person, maybe the retail investor, is still really skeptical.
Or just cautious. Worried about a sudden drop.
Yeah, worried the floor might just fall out from under them. That's the feeling.
And that fear, or maybe just the volatility, it translated into some serious pain yesterday. Over $381 million lost in liquidations, just in 24 hours.
Ouch.
Now, for listeners who maybe don't track futures daily, can you quickly explain what a liquidation is and why it matters that the source noted $205 million of that was specifically from short positions, people betting on a drop?
Absolutely. So think of liquidations basically as forced sales.
Right.
Traders use leverage that's borrowed money to make bigger bets. If the market suddenly moves hard against their bet, the exchange automatically sells their assets. That's to stop their account going negative. Boom, liquidated.
Got it.
Now, the critical point here is that $205 million, the bigger chunk, was lost from short positions. Those are bets that the price will go down.
Okay.
So what's fascinating here is, yeah, we see rising prices, but also this background anxiety. But paradoxically, the people betting against the rise, the short sellers, they were the ones who got hammered the most. It suggests this upward push, probably fueled by the institutions. It's strong enough to just wipe out big groups of traders betting against it, which of course probably just reinforces that fear and volatility for everyone else.
That really sets the scene, doesn't it? Retail is scared, maybe getting burned, while the big money keeps pushing higher. And maybe that retail anxiety is exactly why regulators are stepping in now, trying to build some guardrails, move us away from the, Wild West days.
Towards formal integration, yeah.
And the pace of that government integration, just in the U.S., is kind of striking. Locally, New York City, Mayor Eric Adams just set up this Office of Digital Assets and Blockchain Technology by executive order.
Yeah.
Is this just like political posturing, or does it mean something practical?
Oh, I think it's very practical. It's about being proactive, not just reactive, right?
Yeah.
This office, its job is basically to cut through red tape, create regulatory clarity.
Okay.
It positions NYC not just as a place to trade crypto, but a place to actually build blockchain stuff. It's basically a big sign saying, innovators, come here, we get it, and we'll help you.
Right, attracting talent in business.
Exactly. And then nationally, the push is towards making crypto accessible for, everyone. Representative Troy Downing introduced a bill. It aims to strengthen an older executive order.
Okay, and the goal?
The really critical goal is explicitly allowing crypto and other digital assets into 401k retirement accounts.
I've heard it.
Well, that's monumental if it happens.
It really is. I mean, if that passes, we could be talking trillions, potentially, of retirement dollars getting exposure to digital assets for the first time. That fundamentally changes the game for American retirement savings.
Completely. And speaking of assets on a national scale, Senator Cynthia Lummis was highlighting two urgent things for Congress. This came up because, remember, they seized a huge amount of Bitcoin, like 127,000 BTC.
Right, from illicit sources.
Yeah. So first she says, pass a proper digital asset market structure law. Clarity, finally, something the industry's been begging for. And second, figure out exactly how that seized Bitcoin should go into America's strategic Bitcoin reserve.
Wow, a strategic Bitcoin reserve. We're definitely not talking about niche assets anymore. This is like national strategy, sovereign wealth almost.
It's becoming part of the national balance sheet discussion.
Okay, here's where it gets really interesting. Because this whole process of making things official, it's not just the U.S. International players are doing it too, cementing digital assets into their laws. It feels like formal acceptance is happening globally.
Yeah, we're seeing different flavors of regulation popping up, tailored to what each country needs. Japan, for instance, they're focusing on market integrity.
How so?
They're planning new rules to ban crypto trading based on non-public info, basically bringing insider trading rules to crypto.
That's huge for confidence.
Yes.
Especially institutional confidence.
Massive. It applies the same kind of fair play rules from traditional markets. And then you look at emerging economies, maybe focusing more on just official recognition. Kenya, for example.
Where do they go?
They've officially added rules for digital asset service providers into their actual legal framework. That gives clarity for businesses there. And it just acknowledges the reality that lots of Kenyans are already using these assets.
So both ends of the spectrum, developed and emerging economies.
Exactly. Right. Japan, Kenya. They're both confirming in their own ways that digital assets aren't on the fringe anymore. They're a formal governed sector now.
Globally.
And governing it means the big institutions, the whales, they can pour in capital with less legal worry. Which brings us nicely to tracking those whales. The institutional power flooding in. It's just staggering. I mean, look at the buying on just one day, October 14th. It was enormous. Roughly $102.7 million in Bitcoin and a whopping $236.2 million into Ethereum, just snapped up by institutions.
Over $338 million in a single day.
Yeah. Can you maybe put into context how a single transaction, like Fidelity's Ethereum ETF buying 36,460 ETH, that's, what, $154.6 million? How does that impact the market overall?
Well, these kinds of purchases, they're the difference between just a busy trading day and a real structural shift. You know, retail traders might move the price minute by minute.
But big ETFs like Fidelity's, they're usually strategic long-term holders. When they buy up $154 million worth of ETH, that takes a significant chunk of supply off the open market. It locks it into this regulated structure. It acts like a huge stabilizing force, potentially dampening volatility over time.
Okay, less available supply, more stable base.
Exactly. And if we connect this to the bigger picture, we also look at liquidity movements, right? Where's the dry powder coming from? Tether, the issuer of USDT stablecoin. They just printed another billion USDT yesterday.
Like billion, wow.
Printing that much USDT is generally seen as, well, meeting incredibly high demand. It often signals that new money, new liquidity is about to flood into the market. It's like a behind-the-scenes vote of high confidence. Someone needs that USDT to buy something else, likely BTC or ETH.
And it's not just ETFs. Fidelity clients, or regular clients, apparently bought $132.7 million worth of Bitcoin, too, outside the ETF. But the stat that really jumped out at me was the corporate accumulation.
Oh, yeah. That points to the long-term structural change. It's unavoidable. The number of actual investment companies holding Bitcoin, it's up 40% in just the last 3 months.
40%.
40%.
Yeah.
We now know of 172 companies holding 1.02 million Bitcoin. That's valued at, wait for it, $117 billion.
Good grief.
This is clear evidence that corporate treasuries, big investment houses, they're not treating Bitcoin just as some volatile trade anymore. It's becoming an essential, maybe non-correlated reserve asset for them.
So the institutional appetite is not slowing down?
No way. It's accelerating the adoption curve. It's basically building out the permanent digital plumbing underneath everything, almost regardless of the daily price swings or, that retail fear we talked about.
And that acceleration is now even leading traditional banks to create their own crypto products. Like on the innovation side, this major French bank, ODDO BHF, they just launched a new euro-backed stablecoin, Urod, they're calling it.
Yeah, that's TradFi fully embracing and integrating crypto tech.
How significant is that?
I think it's profound. This isn't just another stablecoin for trading speculation. It seems designed to make things like cross-border payments and digital settlements smoother within the existing Eurozone banking system.
Ah, using the tech for efficiency.
Precisely. It really highlights the institutional view that, hey, these digital tokens, they're just better plumbing for finance. Faster, cheaper, more secure maybe than the old bank wires.
And speaking of traditional benchmarks, we should probably mention gold hit a new all-time high today, too, $4,200. High gold prices often seem to go hand in hand with crypto strength these days.
Absolutely. Often signals wider concerns about inflation, maybe a general flight to perceived safe havens or hard assets. Hedging appetite is high.
Right.
And in terms of where things might go, the sentiment from some industry leaders is incredibly bullish, especially on assets with clear utility. Bitmine chairman Tom Lee, he was quoted saying that if Ethereum hits $12,000,
$12,000.
yeah, $12,000, he said it wouldn't be some crazy excessive peak like a blow-off top. He thinks it would just be a new sustainable value level based purely on its growing utility and its economic role.
Interesting perspective. Okay, before we wrap the finance news, we really have to touch on recovery efforts. After some recent market turbulence, resilience is key. Binance just launched this $400 million thing called the Together Initiative. What's the goal there? It's a lot of money.
It is a lot. The goal seems to be about restoring systemic confidence and minimizing contagion risk. You know, the fear that one player failing could drag down the whole system.
Right, like dominoes.
Exactly. So this $400 million, it's got a few parts. There's direct support, like giving $4,000 to $6,000 in USDC stablecoins to individual users who lost money recently.
Yeah.
That helps rebuild faith at the retail level.
Okay, direct help.
But maybe even more critical, there's $100 million in loans specifically earmarked for institutions that were hit hard by the recent downturn. It's capital being deployed strategically to keep major players afloat, basically shoring up faith in the big centralized exchanges and platforms while everyone waits for clearer regulations.
Right, keeping the system stable. That focus on resilience kind of brings us to our last bit, the adjacent tech piece. We always like to glance at Web 3.0 and AI because these things often shape where finance is heading.
Yeah, that convergence is, it's definitely happening, and the underlying tech is always evolving. We got an interesting little nugget from OpenAI about their next generation of tools. They're planning a release in December.
Okay, what's the focus?
Apparently, they're focused on restoring highly personalized, context-aware interaction in the next ChatGPT version, making it feel more human-like again, including, interestingly, an adult acting model.
Why does AI getting more personal matter for our finance deep dive?
Well, because the future of Web 3.0 finance, decentralized finance, it likely needs these decentralized but highly personalized interfaces to really take off for mainstream users.
Oh, making it user-friendly.
Exactly. Imagine a world where your financial moves managing smart contracts using DeFi apps are helped by an AI that actually understands your context, acts like your personal agent. This push for more human-like AI interaction, it feels like a necessary step to make these complex, decentralized systems truly easy to use for, well, everyone.
Okay, so what does this all mean when you put all these pieces together from today?
It means the crypto world right now is this powerful contradiction, isn't it? The main takeaway, I think, confirms that regulation, whether it's NYC's new office or Japan banning insider trading and just colossal corporate money.
Right, that 40% increase in corporate BTC holders, the huge ETF guys.
Yeah, exactly that. Those are the primary, almost unstoppable forces driving long-term growth. But meanwhile, retail sentiment, stuck down there at 37% fear, it's still cautiously watching from the sidelines while others build this massive structure. And the thing is, that structure feels permanent now. And the sheer amount of money flowing in just validates that permanence.
That sums it up perfectly. Okay, so for you listening, here's maybe a final provocative thought to chew on. Given this breakneck speed of institutional adoption we're seeing, the regulations getting finalized, this legislative push to get crypto into 401k, how quickly does digital assets shift from being this niche kind of speculative tech to being a compulsory, like non-negotiable part of mainstream retirement planning and even sovereign reserves?
That's the big question.
Yeah. Keep a really close eye on those political debates around America's strategic Bitcoin reserve. How that gets set up, I think, could define the next decade of government involvement in this whole space. And that's our deep dive for today. We'll catch you next time.